In this lecture, we're going to talk about how to account for warranties, a promise a company makes to replace or repair a product if something goes wrong. Many products come with a warranty. Some warranties are included in the purchase, and some must be purchased separately. From an accounting standpoint, the promise to deliver warranty coverage in the future creates a cost that we have to deal with today, even though the repairs might not happen for months or even years. Here's the core tension. A company sells a product today and promises, if it breaks within a year, we'll fix it. The sale happens now, but the repair, if it happens at all, happens later in a future period. Like all costs, we want to match the expense to the revenue that it relates to. If we only recorded warranty costs when repairs actually occurred, we'd be matching those costs to the wrong period. The promise was part of the sale, so the expected cost of honoring it should be recorded now, in the same period as the sale. Remember this, matching of revenues and costs is what makes the income statement useful. Before we record anything, we need to distinguish between two kinds of warranty because they're accounted for very differently. The first kind is a quality assurance warranty. This is the basic assurance that the product will work as promised. It's bundled into the product, not sold separately, and it's not a separate performance obligation. For this kind, we accrue an estimated warranty cost now. This is our focus in this lecture. The second kind is an extended or service type warranty. This is the kind you pay extra for at the checkout counter. Because the customer purchased it separately, it is a distinct performance obligation. We would not accrue a cost for it. Instead, we would record deferred revenue and recognize that revenue over the warranty period as we provide the service. So keep these straight. Quality assurance warranties get accrued as a cost, while extended warranties are deferred revenue. Let's focus now on the quality assurance warranty. Remember that the governing idea is the matching principle. We record the expected warranty cost in the same period as the revenue it relates to. There are 3 steps. First, we estimate the warranty cost, usually based on historical experience, what percentage of products typically need repair, and what those repairs typically cost. Second, we accrue the estimate at the time of sale, recording both a warranty expense and warranty liability. And third, we settle the obligation later, as actual repair costs come in, drawing down the liability that we set up. The estimate is what let us record the costs now, before we know exactly which units will fail. Here are the entries. In the period of sale, we debit warranty expense and credit warranty liability for the estimated cost of future repairs. This is what puts the expense in the same period as the sale. Then, when repairs actually occur, we debit warranty liability and credit cash, or parts, or wages, whatever resources we use to make the repair. Notice that the actual repairs reduce the liability. They don't create new expense because we already recorded the expense up front when we made the estimate. How do we come up with the estimate? Companies are permitted to take different approaches. One common approach is to estimate the expected costs over the course of the warranty period. Maybe we expect more warranty claims at the beginning or the end of that period. Companies would rely on historical data to come up with something that makes sense to them. Another approach is an expected cash flow approach, where we estimate the possible repair costs and then weight them by their probabilities to arrive at an expected value. Either way, we know that we'll have some warranty costs. We're just estimating how much. Let's do a simple example. Here's a company that sells in-home healthcare products. They've introduced a new therapy chair and they've decided to include a 2-year warranty. Sales of the chair are $2 million this year. The company estimates that warranty costs will be 3% in the first year after the sale and 4% in the second year of warranty coverage. Actual customer claims were $61,000. So the first thing we need to do is record the sale of the chairs, and then we also need to record the expense of the warranty that came with the chairs. So we've got our equation up here, and to record the sale, I'm going to debit cash, we'll assume that it was cash, for $2 million, and credit sales revenue for $2 million. So I need a cash account here that I'll put 2 million in, and I need a revenue account here that I'll also put 2 million in. Next, we need to record the warranty expense, and we've got 3% of costs are estimated for the first year, 4% for the second, but the idea of warranties is that we record the expense all now, even if we don't expect those costs to be actually incurred until later. So the 3% and the 4%, 7% total of the sales revenue needs to be recognized as warranty expense. So 7% of $2 million is $140,000. And we'll credit warranty liability. So by doing this, we get this $140,000 cost on the current year income statement, matching the revenue and expenses. And then under liabilities, we'll put warranty liability of $140,000. Very good. And then finally, we'll record the customer claims that came in. So the claims, whatever period they happened in, we would debit warranty liability for $61,000 and credit credit cash for $61,000. So we'll credit cash for $61,000 and we'll debit warranty liability for $61,000. We're assuming that it's cash in this case, but it could be other things that we might have to credit that we used in order to service these warranties. But either way, we've got it up to date. Our warranty liability is up to date, and any adjustments that need to be made to it down the road can be adjusted accordingly by increasing expense in the period that we know that that's true. To wrap up, a quality assurance warranty is part of the product, not a separate performance obligation. We estimate and accrue the warranty cost in the period of sale, matching the expense of the revenue that it helped us earn. We record a related liability and then reduce the liability as actual repairs occur. And remember the difference between quality assurance warranties that are included with the product and extended service type warranties that are purchased separately. Those are deferred revenue and are earned over time.